Hey guys, Whitney here. Welcome to another installment of How to Get Started as a Passive Investor. I am so blessed today. We have a guest today here, our very own Maggie Vineyard. She is our program analyst. I'm so excited to have her here today. And we're going to dive into a pretty hot topic, kind of like high-level deal underwriting, what we do here at Goodegg Investments. But before we jump in there, we do these webinars on a weekly basis, really to help you understand as a limited partner, how all these mechanics work to get started in passive investing. Maybe you've tried passive investing before, but you just never pulled the trigger, you got cold feet. Or maybe you actually invested in a deal before and went, oh, I made a mistake, guilty as charged. I've done that before. Or maybe you just feel so overwhelmed by all the information out there, you just don't even know where to start. This series is for you. You are in the right place. But one of the myths that keeps a lot of investors sidelined is that they feel like they have no control over the asset. Okay, they're moving from active investing to passive investing, and it's scary because they feel like they have no control. Well, Maggie is going to show you that you have an immense amount of control today because you get to control who you work with, the strategy you invest in, where you invest, and the property you invest in. And those are all decisions you make before you even sign a private placement memorandum or even write a check. You have immense control on how this asset will affect your portfolio. But before we get started, just a quick thing, a little bit about me. As your host today, this is me and my crazy crew. This is the reason why I invest in passive real estate, is so I can spend more time with my family, travel, and work location independent. We took the month, not the month off, I shouldn't say that, but we traveled for the month of December in Sedona in Arizona and just got to bike and play, work hard, play hard. My daughter was in school, but this is the reason why I invest passively. I mean, I started investing in 2002, but it wasn't always like that. I was doing live-in flipping and house hacking and wielding the paintbrush and the hammer all myself. And then it just, did that for a few years. But really, it took us a long time to figure out what we needed was income and appreciation and earn that passively. And it was really when we learned how to do this a few years ago that we just blew the doors off of growing our portfolio. And just here, I'm happy to say next month, Goodegg is having another birthday. We're going to be 3 years old, but just in the past 3 years, we've been able to close on 26 multifamily deals. We have over 6,700 units under management and an $800 million portfolio. But what I get to do every day as the director of investor relations is work with you guys, our investors. And so it's fun. I love doing it. So if this is your first time attending, I just want to let you know how you can access this information and other webinars. You're going to get a replay link with this webinar in it and a wealth of other information. But just to let you know, we do this for educational purposes only. So if we dive into any tax, legal, or financial benefits from investing in real estate, I need you to continue to work with your professional to understand how all these benefits impact you personally in your individual situation. All right, but here's a quick little recap of some of the topics that we covered. If you're just starting out, take a little screenshot here of our recap screen. And these are the base webinar replays that I want you to watch to get a good foundation understanding of passive investing. But as always, you're not here for me, you're here for you. I would love, again, to introduce Maggie Vineyard, our program analyst. And Maggie, would you please share a little bit about yourself, how you got into real estate? And then we can dive into our information for today.
Absolutely. Thanks for having me. I'm excited to be here. I joined Goodegg in November of last year, so it's been about 6 months now. Previous to that, I was a multifamily mortgage broker and an analyst for about 8 years. And then prior to that, I was working for a loan broker on the single family side, so analyzing tax returns and putting mortgage loan applications together and credit packages. So needless to say, I've got a lot of experience in terms of analyzing financials, going through hundreds of multifamily properties and their income and expenses, and assisting the buyer with obtaining the right financing. So yeah, I'm excited to be here and back, helping find us those great deals out there, doing all the hard work so you guys don't have to sift through hundreds of deals. Um, just jumping into kind of what we do here at Goodegg, we kind of, I would say we've got like 4 phases of analysis. And it's starting out with a big group of properties coming at us, whether it's ones we find through brokers or ones we've found through our letter campaigns, or just contacting property owners. So we kind of handle a lot of digging, so you don't have to do all that. But the first part really is kind of zeroing in, weeding out a lot of the duds, right? And so the first thing we really focus in on, number one, is the markets that we know. Right now, we're very focused on Texas and the Carolinas, and we know those areas. We've bought there before. We've got properties that we can use to compare, which is really helpful. We see how those properties are operating and can use that knowledge on properties that we're buying going forward. And then we've got great teams in place in terms of property management, brokers, tax consultants, insurance, you name it. There's a lot of people that go into this entire process, right? So focusing on the specific market, and then I would say the next step we look for is really kind of neighborhood specific. So we will look at the median income for that particular neighborhood the property's in. We like to stay, 70,000 or above. We will go below that if the other criteria we are looking at are good, but it's kind of on a case-to-case basis. We're looking at average home prices in the area. We want to really know that our rents are affordable and that there's a strong rental market. If home prices are really cheap in the area, the rental market may not be that strong. So that's something important to look at. Let's see, crime is a big one we look at. I use a website, well, I use a couple, but spotcrime.com is a great website if you want to look up an address of a property and see any arrests or any kind of crime near it. It kind of puts these little icons around your map. And so you really can make sure that the property you're looking at is in a safe area. We also look at the schools in the area, whether the public schools are rated well. So that's very important. We want typically to be in good school districts. Let's see, beyond that, once we've kind of weeded through those items and make sure they check all our criteria in terms of income, we also, well, I guess we should also talk about employment, right? That's a big one I didn't want to forget. Where are jobs? Where are people moving to, and where are their jobs? So as we can all hear in the news, there's a lot of employers, large companies moving to Texas as well as the Carolinas, and we're seeing a lot of migration out of large cities. People want to be in, they want a good quality of life where it's not as expensive. Their kids maybe have yards, they might be able to walk to school even, or so really looking at where people are moving nowadays and where the jobs are is a really important factor. So after we kind of weed out a lot of the properties, that eliminates a good portion of them right there. We zero in on the actual property, and number one, we look at the vintage, the age of the property. Typically, we won't buy anything older than 1980, built before 1980. Again, we will make exceptions if it's in a phenomenal neighborhood, and there's a lot of value to be added. But we like newer properties. They've just got less headaches, right? Owning a home, or if you've ever done work on your own home, the newer, they've still even got warranties, right, on some of the things. So looking at that as well as the asset class, and then in addition, who are the competitors for that particular property, and what is the market like? How strong is the rental market? Is the vacancy high? And if so, why? Really digging into that is important. I think, a lot of the properties we buy are Class A, and so being very aware of any new inventory, meaning new buildings, new construction coming online. I think nowadays the cost of construction and just the price of land alone really lends to just builders being able to develop Class A properties. So if you're buying Class A, that's something you want to really be cognizant of. Beyond that, looking at your competing properties, where are their rents? What do we have that they don't? How can we lure, if you will, tenants to our property over theirs? And that can take a lot of time to dig through. We have access to CoStar, which is excellent for comparing properties. If you don't have that, you could also use like apartments.com. It'll just take you a bit longer to sort through the information. So I would say once we've kind of done that on a hyper level and still determined that this property looks like a good opportunity, meaning either we think there's a sort of a way to grow the income, or maybe they're not operating it as efficient as we think we could, then we'll kind of dig into the property and the numbers, and that is I'll get the broker's OM if it is on the market. If not, you don't need that. Using the seller's current rent roll as well as their T12, meaning their income and expense statement for the property for the last 12 months. Using those two items.
Just a second, because I don't want to gloss over this very important analysis that you do, and I've seen you do this on so many of our properties. Like, we'll find a deal, it comes across our desk and get all excited about it. And like Maggie's like, nope, time out, hold on. Here are all the different market metrics, and it doesn't hit this box, and this box. You're just like, oh, okay. But absolutely. I mean, the very important thing, I want to draw out two things here. Real estate is immovable, right? That location is location, right? That's an immutable law of real estate. And you take care of our investors by helping us analyze that for them on their behalf. Two, the vintage of the building is super important, right? Because, we've seen it, in some of our older properties in our portfolio. We've got a couple older properties, but I've also seen it in some of my personal older properties. Galvanized piping, like there are just these things that, building qualities that happened years ago that lead to like just obsolescence and, building failure. And they can be very expensive to fix. And oftentimes you don't even know that you need to fix it until like the sewer backs up and takes a few units offline or something crazy like that. So super important. So thanks for piecing that together. And then like that brings us back to the property and diving into all these metrics. Man, guys, the spreadsheet that Maggie uses is insane. Insane. I bless you that this is your thing and you love doing this.
I mean, it is a lot. And of course, the more you use it, the less intimidating it becomes. But having these tools and having even this spreadsheet to use, and knowing what's a good spreadsheet and what's not. Like, there's a lot of models out there on the web that you can, and they all have pros and cons to them, but having a good model and knowing what you're looking for. Anybody can look at a spreadsheet with a bunch of numbers, but if you're not really able to decipher what's wrong with those numbers, or what kind of inefficiencies there are, right? Or why, maybe their utilities are running really high. If you're not really able to look at that and judge it, it's kind of a worthless spreadsheet, right?
So what specifically are you looking at whenever you get all that data?
So, I mean, I'll start with the income is the first thing. And number one, just making sure their rent roll matches with the actual leases. And then are they actually collecting that money each month? So you might have a rent roll that says you're getting $25,000 a month, but if you haven't actually shown those collections over the past few months, number one, what's going on? Are people not paying? And then number two, it's going to be more difficult to get financing because the bank will certainly look at what your collections have been historically when they are looking at how much money to lend you for this, to buy this property. So looking at that, looking at bad debt, are your leases optimized? Are you charging under market? Maybe you've had tenants in there a long time and you haven't had the heart to raise rents, but at the end of the day, this is a business, and we want to make sure we're optimizing it for our investors. The other thing we look at is ancillary income. So you've got, this customer base at your fingertips. So what other services can we provide to them to make their lives easier and to make them want to stay in the property, right? Because turnover is expensive. If you've got people coming in and out all the time, you've got a vacant unit for a month, then you've also got the cost to replace the carpet and do the painting. You really want to keep your current tenants happy. So looking at ways you can, it's almost like you would upsell and you would a business, but upselling services to them that make their lives easier, make them want to stay at your property. That could be providing laundry, washer and dryer rentals, enclosing their backyard so they've got a pet yard. So many pets out there, right? And then, pet rent is actually a big thing. The wear and tear pets have on properties is significant, and you want to make sure you're making up for that, right? And collecting a bit extra because you may have a higher expense on turning over the unit. Parking is a big one. Can you put in some carports and create covered parking, and would they be willing to pay for that? Or even a reserved spot. If it's an open parking lot and they're having to walk pretty far to get to their unit, they may be willing to pay $25-$50 for their own reserved spot. So looking at any kind of ancillary income and ways we can add value and increase our NOI, right? It's much easier to increase income on a property than it is really to reduce expenses. So again, just making sure we're optimizing this asset for you and increasing the income and again, which in turn increases your value and of course your cash flow each month. So really digging into the income. The next thing I would say, going through the seller's expenses, that can be overwhelming, but I think the more you do it, the easier it becomes. And I've done, like I said, I probably would go through like 30 buildings a day at my old job as an analyst for a bank. So you really get a good grasp of what income or what the expenses should look like. And they vary wildly based on vintage and location. But again, just the years of doing that it's almost ingrained in my brain now, and you kind of do it without thinking, and I could do a whole webinar on expenses, but having a good idea of what the expenses should look like, what it should cost to run your office on site, what on-site staff you need, can we run this building with 2 people in the office and 1 maintenance guy? Or, if it's a smaller property, could we perhaps run, have a maintenance guy kind of go between this property and one nearby that we own and help reduce that payroll expense? Taxes, of course, is a really big one, real estate taxes. You really want to know, we dig into that quite specifically because every state and in turn, even the counties in particular, or even a particular neighborhood might have a special assessment or Melrose if it's a new development. There could be an assessment for schools. So digging into that, knowing what specifically when this area reassesses, and then making sure that's included in your pro forma. I've seen a lot of people make mistakes there, and it's literally the largest expense that you will pay. So you've got to have a really good grasp on that. Insurance, having an insurance broker, we always consult with an insurance broker as well as a tax advisor on every property, just to make sure, there's no surprises. And taxes, I think utilities is another large one. Are we charging back the tenants what we should be? A lot of properties, the owner might pay for all the water, and that can get quite expensive, because if you're not paying for water, you're probably taking longer showers, right? Or you may have 3 or 4 people living in a unit, and that will get expensive because they're all taking showers. So really making sure we've got a handle on our utilities, whether we're paying for them or we are able to charge them back to the tenant. And even, could we perhaps a cable agreement? Could we sign as an owner a bulk cable agreement and therefore give our residents a little better pricing? But in fact, we might be able to make a bit of money. A lot of cable companies have like a revenue share program with the owner. And that's another contract that I will go through if we go to the due diligence period. We get into any kind of third-party contracts that go along with the property. Let's see, what else on the expenses am I leaving out? Of course, having reserves is really important, and you want to have a startup budget. We really dig into what money we need to take over this property. Are we going to have to buy a printer or computers for the leasing office, or do we need to redo, the pool? Is there any deferred maintenance? That's a big one. And again, when you get into the inspection, your due diligence period, the inspection and appraisal, being able to read those reports and really go through them thoroughly is a big part of my job. So there's a lot to cover with that. In terms of expenses, were there items that you wanted me to get into further, or we could save that for another webinar?
I think we can do a whole other webinar, but I want to make sure we leave time for the last 2 pieces to cover. And, can we move on to the debt? And guys, I want you to understand, when we're going through this, especially like when we get into the debt and the sensitivity, like, this is the value that we bring to you as Goodegg, is you're not having to do all this review yourself. You're not looking at all the different ways that you can increase income on the property or decrease the expenses or the different debt structures that go on the property. What Maggie's going to share with you here in just a second on the debt structure is amazing. You can leverage a awesome, solid operations team that knows what they're doing in order to access a property. And that is the power of passive investing, but that's also the power of working with a solid operator with qualified people on the team that know what they're doing, for sure.
Yeah, I think you've nailed it on the head, especially like what is so great about our team is we all have our specific roles, and the way we kind of operate together is like a well-oiled machine, so that I can really focus in on, my underwriting or acquisitions, and having a team in place. It's almost impossible to do all this by yourself, because it's a lot, it's overwhelming, and to be able to do it quickly so that you can seize that opportunity right before someone else gets it. So having a good team, I would say, and in your general partner and the person that's operating it is just essential. Definitely. And people are busy. If you've got a full-time job, I don't know how you would do all this, because this is my full-time job, right? Like, it takes a lot of time. So definitely removing that from your plate and ensuring you've got experts, looking at all this information is really a benefit of being a passive investor. Absolutely. Getting to the debt and equity structure, that's kind of where I would say, the magic happens in today's market. Interest rates are so low, and how you structure the debt and equity to buy this property is so important. It can really win you the deal in many aspects. we're taught when we're young that debt is a bad thing, but it's one of the I would say it's, the beauty of real estate, because you're actually using other people's money, right? The bank's money to purchase an asset for yourself. So leveraging that, and if they're lending you money at 3%, I mean, that's cheap money. And so you're able to put less money out of your pocket, right? And use their money, but you get all the upside. You pay them their 3%. But if the property appreciates, if we're able to increase the cash flow, that all goes into, our investors' pockets, which is the beauty of it. So there's tons of different ways to structure the debt. We've got relationships with a lot of loan brokers as well as mortgage banks. We will really look at the strategy. What are we planning to do with this property? Is it a 5-year hold? Is it a 3-year hold? Is it a 10-year? And knowing what kind of debt you want to put that helps you execute on that strategy is very important. For instance, a lot of the agency loans, which are Fannie Mae and Freddie Mac, have yield maintenance prepays. And so if you're planning to sell the property in 3 years and then you don't realize there's this yield maintenance prepay, it can really affect your numbers. You might not be able to sell that property without paying, $500,000 to $1 million. It can get really hefty. So we spend a lot of time speaking to a variety of lenders, make sure we're matching the right loan with this specific property that's giving you, number one, the cash flow, the ability to exit at the right time, and then obviously low fees and a good interest rate. Borrowing at these crazy rates is just really increasing everyone's capacity to buy. So locking in a good interest rate at this time is great. Let's see, what else can I say? And not only the debt side of the piece, but the equity side, meaning the waterfall structure. The way you structure the waterfall with whether there's Class A and Class B shares can really affect your returns overall, right? And so knowing how to optimize that, and what percentage of this particular structure should go to Class A versus Class B, and the amount you're paying for that. Because at the end of the day, limited partners, if you're using more limited partners and paying those a preferred return of 7%, it's more expensive, right, than if you were to use that portion from a bank loan where you're paying 3%. Mm-hmm. So the way you structure the whole pie is so important, and literally can make or break a deal right now in terms of winning bids. And that's just because how you structure it, you might be able to get more leverage, meaning a larger loan with a specific bank than you would. And that allows you to pay more because you're using money that's cheaper. I don't know if that's making sense, if I'm describing it properly. Okay.
Totally. Yeah, I mean, I like putting it this way because I want to leave like a couple of minutes for us to go over sensitivity.
Okay.
So debt, it's like a hammer, right? You can use the hammer to smack a nail, and the nail to put together something really beautiful that works. Or you can use the hammer and go like punch it in your drywall and create a hole, which doesn't necessarily work, I guess, unless you're demoing a building, like maybe that tool's being. So the debt can cut like two ways, and knowing how to use that tool, and that's the strength that you bring to the team, knowing how to use that debt tool to build something really beautiful, an equity structure that works for everybody, that's a win-win. Absolutely. But I want to make sure that we cover in the last couple of minutes sensitivity, right? Because this is where the magic happens, and the investor gets transparency. The limited partner gets full transparency on the range of returns they could see in the deal, but also the capital preservation, which is so fundamental to our core investing philosophy. So could you touch on some of the pieces that go into the sensitivity analysis?
Absolutely. Sensitivity analysis, like you said, it's so important. And I think the biggest reason that we do it is risk mitigation, right? We're trying to think of anything that could go wrong. to mitigate your risk. And if it were to happen, if our vacancy were to go to 15%, what would that do to your returns and to the value of our property? So mitigating that risk by literally looking at the vacancy rate and varying that number, what our potential rents could be, and how that will affect your returns. And just coming up with a strategy again and plan to mitigate that risk so that your investment is safe. Break-even point really becomes important if it's a value add project, because we might be taking units offline to renovate them. So we want to make sure, if we've got a certain number of units offline, that we're still able to pay all the bills. And that's really why, break-even point is so important. Being cognizant of how many units you can have offline in the case that you are doing a value add. You want to know it regardless, but that's where I think it's essential. Exit cap rate is a really big one right now. No one can really predict the future, right? But we can look at different scenarios. Let's say interest rates go up. How will that affect our exit cap rate and what we have the ability to sell the property at in the future? So, as well as, the property's aging, right? So it's obviously less attractive in 5 years than it is now, because there will be new properties then. So taking that into consideration when we're developing our exit strategy, and making sure that hopefully it sells for the same or low cap rate, and showing you and kind of allowing you to choose, right, the sensitivity analysis, what you think. And so knowing, if cap rates are at 5 or they're at 4, you can really determine what your return will be and the multiple on your initial investment, right? So I think it's really awesome that we do the sensitivity analysis, and you can use that to read it and really get a good picture of the overall investment, and not have to dig into this and create your own spreadsheet, because it's very time consuming. Yeah, absolutely. So the fact that we can kind of present this material to you, and then you've got the power whether you want to invest in it or not, but being able to read those sensitivity analysis and kind of digest the information. And yeah, I think it all works together. So you're just trying to get you guys the best deal, and in turn optimize these assets. Again, they're like a business, so operating it like a business, and it takes a full team. That's for sure.
Definitely.
Mm-hmm.
Well, Maggie, thank you so much for giving us such like a high level 30,000 foot overview on the deal underwriting that you do on behalf of the entire project, including our limited partners. I really see the potential for us to like pick up one of these sections and really dive in at a later time. So I know several people here probably have tons of questions to ask. I'm going to bring you back, and we'll start taking each one of these sections apart. Sure. in greater detail. Sound fair?
Yeah, absolutely. I could talk for hours about expenses.
Totally.
I don't want to bore you all, but yeah, I'm happy to go into further detail and looking at expenses. Yeah.
Well, before we wrap up for today, I just want to, if you guys are not currently on our deal list, you need to join the Goodegg Investor Club. And this is how you can join. Go to goodeggs.investments.com/invest, fill out like a quick little form there, and then follow the rest of the steps in the process. This is really where the rubber meets the road if you want to partner with us and work on a deal coming up here in the near future. And this club is really for anybody, whether you're just starting out, you've never done a deal before, or you're more of a seasoned investor and you've done several syndicated deals. Join the Goodegg Investments Club. That is where we are going to be able to connect you with our deal flow. And as always, I would love to know what you guys want to see covered in future episodes. So be sure to let me know. You can drop that in the chat box, or here's my contact information. You can drop me an email, and I can help connect you to anybody on our team. Maggie, thank you so much for joining us today. This has been wonderful, and
Absolutely.
I look forward to having you back here real soon.
Thanks so much.
All right. Well, guys, thank you so much for spending your most valuable resource today, which is your time, and investing in it not only here with us here at Goodegg, but also in yourself and learning more about passive investing. Have a great day, guys.